Hi everyone, my name's Darren Nakos. I'm the managing partner for Recentric Realty Capital. And today I wanted to talk with you about the power of real estate and pass through depreciation to partners and what that means for your bottom line and taxes. What you see on the screen here is called a Schedule K1. These are issued annually to our partners by the end of February every year. And this highlights the summary of what your investment has done over the year in terms of gains and losses and your capital account status, etc. This particular entity is RRC 5657 Himalaya. This is an asset we purchased late last year in 2019. But what I want to highlight on this particular K1 is the ability to generate a loss, a paper loss, that we then pass through to each partner relative to their pro rata share. This partner actually happens to be myself. We're the largest investor in this particular deal. Our initial capital contribution was $335,000, as you can see here. And on this K1, we were able to harvest a $134,190 loss that was passed through. And you may be asking, how did we do that? Well, there's this special IRS tax code depreciation tool called a cost segregation study. And what this does is it enables you to accelerate the depreciation on different parts of the building faster than your typical 39-year depreciation schedule. So you basically pay for this study. They come out, they take photos, and they highlight certain elements of the building that you can depreciate, such as mechanical, plumbing, roof, electrical, etc. And that gets accelerated or front-end depreciated on the building. On this particular asset, we were able to generate roughly $1 million loss for this entity. And this is just on paper. We're able to then pass that through to each of our investors relative to their pro rata share. So you can see that up here, I was able to generate for myself a minus $134,197 loss. This K1 that gets sent to my accountant, and relative to all the other tax issues we have going on in our different entities, we're able to harvest losses against gains. Whether they're long-term or short-term, that's up to your accountant and how they're going to apply that. But this has been a great tool for us over the years and our partners to reduce our marginal tax rate and legally reduce the amount of taxes that we pay. Now, eventually this needs to be recaptured once the asset sells, but that's down the road. So essentially this becomes a tax-free or interest-free loan from the federal government that improves your cash flow and allows you to invest those dollars somewhere else in the meantime. So this is one of the many benefits of healthcare real estate investments. If you have any questions, please let us know, and thank you for listening.